Stock of the day. I thought we'd take a look at what do they call it? Death care, Invocare, the big funeral directors, cremation people. Under takeover offer, mergers and acquisition play there with TPG Capital, one of the private equity groups. They've been TPG granted another extension on its proposed $13 a share bid for Invocare. The proposed bidder's exclusivity period will now end on July 17. The May offer way back in May, came after TPG walked away from its previous $12.65 cash per share bid in late April. So are alarm bells ringing? Could they walk away? Well, if you're an Invocare shareholder, what should you be doing? Philip?
There's a phrase in my industry called time kills all deals.
Right.
And you don't love an extension. And I'm not overly familiar with the transaction, but based on what's been released today, there's been no suggestion in the offer price will be upped. It's just more confirmation of what's public, and what's public is a $13 per share takeover offer. Share price is $12.50, $12.60, that sort of range. If it goes ahead, you still have to wait a few weeks to get your money. I would take the money and run. It seems like there's limited upside from $13, maybe get a frank dividend in there somewhere. But I would just say it's taking too long. Put the money into something else. It's had a good bounce off its lows. Yeah. I would sell and let somebody else worry about it in the next 7 days.
Yeah, because it has a good bounce. You saw where that spike upwards towards the right of the chart there. That's when the bid was made. So it's been around a while. Sell, take your money and run. Mark Moreland, what would you do?
I'd definitely sell now.
Yep.
It's too close to the number, and I totally agree. There's a chance that it falls through.
Yeah.
If you actually look at it, the company Invocare was going well in 2017, and since then it's been pretty well downhill in a zigzag pattern. But their earnings have dropped over the last 5 years very significantly, which means
now COVID would have hurt that because it's Australia's biggest. They call it death care company or something, don't they? So it's cremations, funerals.
It's insurance
all
as well.
It's
prepaid funerals as well.
Yeah.
The funny thing about the
but you couldn't go to funerals.
The undertakers, they're considered to be all dour and serious. I remember when I was young, I went to. They had a big conference. It was like the Undertaker's Ball. It was the wildest party I've ever been to. It was full on.
They're
going to be so serious. They're going to be so serious that when they let their hair down, they really let their hair down.
Well, the original CEO of the company, when they had their first downgrade, because they missed volumes, they said, "Look, volumes were down. There's nothing legal we can do about that."
Yeah, but before COVID. They were already, if you look at the earnings, remember we're focused on earnings rather than, let's say, okay, look at earnings. Earnings in 2017 were 56 cents a share. Then in 2019 they were 43. And then 2020, 13. Now, okay, let's blame that on COVID. Yep. Then it jumped back to, post-COVID on 21, dropped back to 32 cents. So still way under what it was, and then dropped off again, since then. Right. So that's not good.
Right.
So nothing in that. Now this is a big business. It's quite capital intensive. They spend about 63 million a year on average on capex, which is a lot out of the free cash flow.
Because they tried to, I remember reading a report. They tried to convert their funeral homes into licensed premises because the trend was rather than have sandwiches at a funeral, the wait became a massive party and celebration. Yeah.
Absolutely, it was a reasonable idea.
Yeah.
And their debt to equity is very high. It's at 70% debt to equity. I think they've got 362 million in long-term debt.
Right.
Now that you've got to remember, we're in an environment now where interest rates have not just gone up. We've had the biggest rise in history. And we don't know where it's going to end. And as that debt rolls over, and I have no idea what their terms are, that increases costs significantly. So companies that have a lot of debt, it's going to be a real drag going forward on their earnings as well. So I think TPG are paying a very high price for it. It's about a 28 PE, which is, and their earnings are negative.
Right.
So we're showing it returning negative 29% a year if they continue doing what they're doing. Now, as I said, we'd have to give them a bit of a get a jail free card on COVID, but overall, it's expensive, which means, and the prospects are questionable. So I would take my money.
Take your money and run.
Absolutely.
At 100
And good luck to
miles an hour.
TPG. But see, TPG would probably be assuming they're going to come in and re-engineer it all and make the assets work harder. They obviously believe they can make it work, which is what private equity does. And good luck to them.
Yeah. Okay. All right. Take your money and run.